Soaring inflation fuels bets on sharper Fed fee hikes. Stubbornly warm U.S. inflation is fueling bets that the Federal Reserve will get extra competitive, approximately seeking to cool price pressures or even doubtlessly ditch its own forward steerage by turning in a jumbo-sized interest fee hike in coming months. Fed policymakers had already however promised half-point hobby price hikes at their meeting next week and again in overdue July, following May's half-point hike and the start of stability sheet reductions this month. That would be extra policy tightening inside the area of 3 months than the Fed did in all of 2018. On Friday, buyers of futures tied to the Fed coverage price commenced pricing in a fair bolder direction after U.S. Labor Department records confirmed sharply higher meals and document gasoline prices pushed the Customer Fee Index (CPI) up 8.6% ultimate month from a 12 months in advance. A separate University of Michigan survey confirmed longer-term inflation expectancies rising to their maximum considering the fact that 2008 prices of Fed funds futures contracts now mirror better than even odds of a 75 basis point price hike by July, with a 1 in 4 risk of that going on next week, up from 09/20 earlier than the inflation document, and a policy rate in as a minimum the 3.25%-3.5% variety at 12 months stop. Yields at the 2-year Treasury observe, seen as a proxy for the Fed's coverage rate, crowned 3% for the primary time because 2008. We accept as true with that modern-day inflation records each the CPI and UMich inflation expectations are sport changers as a way to force the Fed to interchange to a better equipment and front-load policy tightening, wrote Jefferies' Anita Murkowska, who joined economists at Barclays Lon, BARC, on Friday in forecasting a 75 basis point fee hike on the Fed's June 14-15 meeting. Most economists nevertheless expect a half-point hike next week, and more of the same at subsequent conferences through as a minimum September if no longer similarly. Core CPI, which strips out risky power and meals prices, rose 6% in May, down slightly from April's 6.2% pace but far from the clean and convincing sign of cooling charge pressures that Fed Chair Jerome Powell has said he desires to look before slowing fee hikes. Any hopes that the Fed can ease up on the tempo of fee hikes after the June and July conferences now appears to be a protracted shot, wrote Bankrate chief financial analyst Greg McBride. Economists at Deutsche Bank (ETR), DBKGN, concurred, and said they now forecast quotes to rise to 4.125% by means of mid-2023. Fed policymakers on the close of subsequent weeks' assembly will release their own pleasant guesses of the way excessive they'll need to boost short-term quotes. They'll additionally provide forecasts of ways a good deal unemployment now at 3.6% may also want to rise before the financial system slows sufficient to reduce inflation. In latest weeks some had expressed the wish that by using September their personal price hikes, along with easing supply chain pressures and an predicted shift in household spending far from scarce goods and toward offerings, might have began to ease fee pressures and allowed them to downshift to smaller fee hikes. Friday's inflation record recommended the opposite. Used car costs, which were sinking, reversed course and rose 1.8% from the previous month. Airline fares rose by 12.6% from the prior month and 37.8% from a 12 months in advance. Prices for safe haven wherein traits tend to be especially continual rose 5.5%, the largest jump in more than 30 years. The Fed's contemporary coverage fee target is now 0.75p, c 1%. Fed officers need to get it better without undermining a historically tight labor market and sending the economy into recession, but accelerating inflation will make that a hard assignment. These are unsightly numbers. I'd say we'll likely be in a recession in the fourth area of this year with confirmation inside the second quarter of 2023, said Peter Cardillo, leader market economist at Spartan Capital Securities.